A 94-year-old man with arguably the sharpest investing mind of the last century, a track record that's beaten the market for over 6 decades. Right now, he's barely buying anything. Berkshire Hathaway is sitting on nearly $397 billion in cash. That's enough money to buy almost any company in the S&P 500 outright, all but about 24 of them, in cash, sitting there. And for 14 straight quarters, over 3 years running, Buffett and his team have been net sellers. Apple, Bank of America, Amazon, quarter after quarter. The question isn't whether Buffett is making money. He always does. The question is, what does he know that the rest of the market doesn't?
Here's the thing about Warren Buffett. He isn't a typical investor. This is the same man who built up cash right before the dot-com bubble collapsed in 1999. The same man who did it again right before the 2008 financial crisis. Both times, people called him out of touch. Both times, the market proved him right. Now, in 2026, the pattern is repeating for a third time. And this time, the stakes are higher, because Buffett isn't even in the driver's seat anymore. Greg Abel took over as CEO in January 2026. Buffett is now just chairman. So this isn't just one investor playing defense. This is a leadership transition happening in real time. And the signal Berkshire is sending could mean one of two very different things. Either a warning for the entire market, or just a very large, very boring math problem. Both could be true. Let's find out which one actually holds up.
Berkshire Hathaway started as an insurance company. Insurance works like this. People pay premiums, the company invests that money, and pays out claims later. The money sitting in between is called float. For decades, Buffett used that float to buy into some of the best businesses in the world. But using float requires one thing: a good business available at the right price. By late 2023, Apple alone made up nearly half of Berkshire's entire public stock portfolio. That kind of concentration is dangerous. So Buffett started selling, trimming the Apple position by more than 75%. Not because Apple's business went bad. Buffett himself has said Apple is still an extraordinary company, and it remains Berkshire's largest single holding. So why sell? 2 reasons. First, valuation. When Berkshire originally bought Apple, it traded at a price-to-earnings ratio of around 12 to 16. Today, that number has climbed to 28 to 32. Same business, roughly double the price. Second, taxes. Buffett expects capital gains tax rates to rise in the coming years, so locking in gains now at current rates is simply the smarter move. This isn't panic selling. It's a calculated, disciplined retreat.
Here's where it gets interesting. Holding cash isn't free money sitting idle. Berkshire parks most of it in short-term Treasury bills, currently earning somewhere around 4 to 5%. On $397 billion, that's roughly $17 to $20 billion a year in interest income, without lifting a finger. So on one side, you have headlines screaming that Buffett is bracing for a crash. On the other side, there's a far less dramatic and far more likely explanation. Berkshire has simply gotten too big. It needs what analysts call elephant-sized deals to actually move the needle. Smaller companies don't matter at Berkshire scale. And right now, there just aren't enough large, attractively priced businesses to buy. This isn't a crash prediction. It's a disciplined buyer saying plainly, I don't see anything worth the price right now. But here's the irony. The market has turned that cash pile into such a massive story that finance YouTube, newsletters, and headlines everywhere are running with Buffett warns of crash. Meanwhile, in his own annual shareholder letter, Buffett never once used the word crash. He wrote that equities remain his forever preference and that cash will never replace good businesses in Berkshire's strategy. So the thing generating the most fear was never actually confirmed by the man himself.
Hype versus reality. Let's put the two side by side. The hype? Buffett knows a crash is coming. The market's about to collapse. Sell everything. The reality? In the first quarter of 2026, Berkshire opened a brand new $2.65 billion position in Delta Airlines, its first airline investment since dumping all four major U.S. carriers at a loss during the pandemic. They also opened a new position in Macy's. This is not a company hoarding cash and hiding. This is a company being extremely selective, buying only where it sees real value. That selectivity is the actual signal here, not blanket cash hoarding. One more reality check. Greg Abel, the new CEO, told shareholders at the May 2026 annual meeting that he sees a unique opportunity in Berkshire's core businesses. But he didn't announce any major acquisition either, meaning the new leadership is following the exact same patient, unglamorous discipline Buffett has practiced for decades. This isn't a dramatic exit. It's a company saying, we'll wait until the price is right.
Now zoom out. Berkshire's cash now makes up more than 30% of its total assets, the highest proportion in at least 3 decades. That number alone is an indirect message to the entire market. Current valuations don't look attractive. Meanwhile, the S&P 500 is trading near record highs. Retail investors are doing exactly what advisors recommend: dollar cost averaging, steady contributions to their 401ks. But the most successful institutional investor in modern history is doing the exact opposite: sitting, waiting. Both approaches can be right at the same time. For most individual investors, staying consistently invested is still the smarter long-term strategy because they don't have Berkshire's kind of market-moving timing power. But for a firm whose entire business model is buy cheap, sell expensive, today's market genuinely looks expensive. And that's where the real risk sits. When an entire ecosystem, retail investors, hedge funds, and the largest disciplined value investor on the planet disagrees this sharply about pricing, it usually means something unusual is happening. Either the market is overvalued or Berkshire is being overly cautious. One of those two is going to be proven wrong.
History says that when Buffett builds up cash like this, something big tends to follow. It happened in 1999. It happened in 2007. But one thing has never been true before. This time, Buffett isn't the one holding the wheel. Greg Abel is, and Abel hasn't shown his own pattern yet. Will he be just as disciplined as Buffett, deploying that cash the moment fear grips the market and prices finally crack? Or will that $397 billion just keep sitting there, year after year, quietly earning interest, waiting for an opportunity that may never actually come? Buffett has always said his legacy isn't about predicting exact market tops. It's about avoiding permanent loss. So the real question isn't whether Buffett is right. It's whether by the time he finally moves that cash, it'll already be too late.